Unit 3, Other Hands in the Money Game. Introduction and Objectives. Lesson 1, the U.S. Treasury. Lesson 2, the Federal Deposit Insurance Corporation. Lesson 3, the Federal Home Loan Bank System. Lesson 4, Monetary System Information Resources. Lesson 5, Money and the Monetary System Study Sheet. Monetary System Information Resources. Source information available: how a licensee can use the information. Federal Deposit Insurance Corporation, www.fdic.gov, informs consumers about depositor insurance and provides educational materials about consumer protection, financial literacy, and using money wisely. It may not come up, but if it does, you will now know how the FDIC insures deposits, and can refer clients here if asked. Federal Home Loan Bank System, www.fhlbanks.com, reports activity related to the financial strength and liquidity of the market. It's important to understand the local lending market, and how the FHL banks fit in. A buyer client may ask about working with a member bank, not likely, though. Federal Housing Finance Agency, www.fhfa.gov, publishes many reports and statistics related to housing, including the House Price Index, HPI, foreclosures, refinancing, and an annual housing report. Understanding FHA underwriting rules is vital to your role when representing buyers or sellers. The FHA is involved with close to 15% of all home loans. Federal Reserve, www.federalreserve.gov, makes available a wealth of information related to economics, monetary policy, and Fed activities. Keeping tabs on economic happenings nationally will help you spot trends and better assist your clients in purchasing, selling, and financing decisions. U.S. Treasury, www.treasury.gov, provides consumers with information about government securities and bonds, currency, budgets, and financial data. Gives you an overall picture of the country's financial condition. The Federal Home Loan Bank System. The Federal Home Loan Bank, FHLB, system is a collective of 11 regional government-sponsored banks that provide low-cost funding to financial institutions, not consumers, enabling them to provide home mortgage loans, and small business, rural, agricultural, and economic development lending. Together with its members, the FHLB system represents the nation's largest combined source of home mortgage and community credit. Member banks own stock in their regional FHLB, and can borrow money from district FHLBs for up to 1 year without collateral, or for longer periods with collateral. If collateral is used, it takes the form of government securities or existing real estate mortgages. Borrowing money provides a member bank with the funds to keep making loans in its community. Without the FHLB system, fewer funds would be available to make real estate loans, and the funding that's available would be more expensive. FHLBs are regulated by the Federal Housing Finance Authority, and the FHLB is considered a government-sponsored enterprise. The Federal Home Loan Bank System. The Federal Home Loan Bank, FHLB, system is a collective of 11 regional government-sponsored banks that provide low-cost funding to financial institutions, not consumers, enabling them to provide home mortgage loans, and small business, rural, agricultural, and economic development lending. Together with its members, the FHLB system represents the nation's largest combined source of home mortgage and community credit. Member banks own stock in their regional FHLB, and can borrow money from district FHLBs for up to 1 year without collateral, or for longer periods with collateral. If collateral is used, it takes the form of government securities or existing real estate mortgages. Borrowing money provides a member bank with the funds to keep making loans in its community. Without the FHLB system, fewer funds would be available to make real estate loans, and the funding that's available would be more expensive. FHLBs are regulated by the Federal Housing Finance Authority, and the FHLB is considered a government-sponsored enterprise. The Federal Deposit Insurance Corporation, FDIC. 5-person Board of Directors. Members are appointed by the President and confirmed by the Senate. No more than 3 members can be from the same political party. Funding is received from bank and thrift premiums and U.S. Treasury security earnings. The FDIC insures deposits up to $250,000 per depositor, per bank or thrift institution, and inspects operations and soundness of banks. Insured equals deposit accounts, including checking accounts, savings accounts, money market, certificates of deposit, CD. Not insured equals mutual funds, securities, stocks, bonds, insurance, and annuity products are not insured by the FDIC. The U.S. Treasury. What is the U.S. Treasury, anyway? The U.S. Treasury may be one department, but it's comprised of several bureaus. Here are a few. Bureau of Engraving and Printing, BEP designs and produces currency. Bureau of the Fiscal Service, provides accounting, financing, collection, payment, and shared services. Community Development Financial Institution, CDFI makes credit and financial services available to distressed communities. Financial Crimes Enforcement Network, FinCEN supports investigations of financial crimes. Inspector General, performs independent audits, investigations, and reviews to support the U.S. Treasury. Internal Revenue Service, IRS determines, assesses, and collects taxes. Office of the Comptroller of the Currency, OCC charters, regulates, and supervises banks. U.S. Mint, designs and produces coins. What does the U.S. Treasury do? Promotes sustainable economic growth and stability. Ensures the country's financial security. Advises the President on economic and financial issues. Improves financial institution governance. How does the U.S. Treasury do this? Manages federal finances, government accounts, and public debt. Produces currency and coins, and issues government securities. Collects duties, monies, and taxes owed to the U.S. and pays what is owed by the U.S. Supervises national banks and financial institutions. Enforces finance and tax laws. Investigates counterfeiters, forgers, and tax evaders, along with other government agencies, including the FBI and the Secret Service. Treasury in action. Treasury collects money through income tax payments, Social Security payments, and other means. Treasury deposits these funds with the Federal Reserve, domestic, and foreign banks. Treasury funds government spending and pay bills. When spending and bills are less than revenue, this is a surplus. When spending and bills are more than revenue, this is a deficit. To resolve this deficit, the Treasury may issue securities, or debt instruments called treasuries. These are guaranteed by the full faith and credit of the U.S. government. These vary by maturity length, or when the debt is paid back in full. Treasury bills, short-term maturities, usually 1 year or less. Treasury notes, intermediate-term maturities, ranging from 2 to 10 years. Treasury bonds, long-term maturities of 30 years. By selling treasuries, the Treasury is essentially pulling money out of the economy. The U.S. Treasury and the 2007 financial crisis. Let's look back at the U.S. economic situation after the subprime mortgage crisis. Financial institutions were in trouble, with Fannie Mae and Freddie Mac on the brink of collapse. In an effort to stabilize our financial system, boost credit markets, help families avoid foreclosure, and promote economic growth, President Bush signed into law the Troubled Asset Relief Program, TARP. This program gave the Treasury permission to spend as much as $700 billion on economic relief. The Dodd-Frank Act subsequently lowered this amount to $475 billion. The Treasury was authorized to attempt to stabilize the financial system by investing capital in and buying assets from financial institutions. This helped to avoid failures of large institutions and increased confidence in the financial system. Boost credit markets by purchasing assets and providing capital to Fannie Mae, Freddie Mac, and other secondary market institutions. This kept Fannie Mae and Freddie Mac operating, and jump-started secondary markets that had largely stalled, which led to improved availability of credit and loans. Prevent avoidable foreclosures by providing mortgage relief to qualified homeowners and aid to specific areas that were hardest hit by the economic crisis.